What if you were told that a number, a simple ratio, holds the key to understanding everything happening in the markets right now? What if that number, buried in historical data, points not just to higher prices, but to a fundamental recalculation of what wealth itself actually is? The number is 2.24. It is not a price. It is a relationship between the world of stocks and the world of a physical metal. That relationship, when applied to today's financial landscape, points to a figure that seems impossible: silver at $3,111 an ounce. This is not a prediction born of hope or hype. It is the cold, mechanical output of a mathematical formula that has existed for decades. It is the sound of a pendulum that has swung too far in one direction, beginning its violent swing back. To understand why this number matters, you must first understand what has been lost. You must understand the official action that set this entire imbalance in motion. The story begins not with a market event, but with a quiet, persistent policy. For over 2 decades, the official action by the world's most powerful financial institutions has been to treat money as an abstraction. Interest rates were held at zero, and then below zero in some parts of the world. Trillions of dollars, euros, and yen were created through quantitative easing, a term for central banks buying financial assets with newly created money. The goal was to stimulate economies, to prevent collapse after the 2008 crisis, and to sustain growth. On the surface, it worked. Stock markets soared. Asset prices inflated. A new generation of investors came to believe that markets only go up. But this action had a secondary, less discussed effect. It inflated the value of financial assets, stocks, bonds, real estate, relative to everything else. It created what economists call a wealth effect, where people feel richer because their stock portfolio is worth more, and thus they spend more. However, this wealth was built on a foundation of expanding debt and expanding money supply. The total value of global financial assets, all the stocks and bonds in the world, ballooned to unprecedented levels. Recently published estimates put that figure at over $400 trillion. Within that, the U.S. stock market, represented by indices like the S&P 500, became a beacon of this financial engineering. Its rise was spectacular. But this official action, this decades-long project of financial asset inflation, created a distortion. It widened the gap between the value of paper claims on future earnings and the value of tangible, finite things in the ground. It made the stock market, in a sense, a measuring stick for confidence in the system of money creation itself. When you buy an index fund, you are buying a slice of corporate profits, but you are also making a bet that the currency those profits are measured in will retain its worth, and that the system allowing those profits will continue. The relentless rise of the S&P 500 was a vote of confidence in that system, but every action creates an equal and opposite reaction. The reaction is now becoming visible. The official action of printing money and suppressing interest rates did not create more copper, more lithium, or more silver. It did not dig new mines. It simply created more claims on existing resources. The ratio between the ever-growing mountain of financial claims and the slowly growing or even shrinking pool of physical commodities became stretched. This is why the number 2.24 is so critical. It is a snapshot from a moment when that stretch reached its breaking point, when confidence in paper faltered and the value of physical things was reassessed in real time. That moment was January 1980. Today we are living with the consequences of the official actions taken since that moment. The gap has never been wider, and gaps in nature and in markets always close. This brings us to the heart of the fracture, the paper market versus the physical market. They are two separate worlds, operating under different rules, but linked by a single price on a screen. In the paper market, silver is a ticker symbol, SI. It is a futures contract traded on the COMEX in New York or other exchanges. When a hedge fund or an algorithm trades a silver futures contract, they are not thinking about bars in a vault. They are thinking about price momentum, volatility, correlation with other assets, and economic data points like inflation reports or job numbers. The market is deep and liquid. Hundreds of millions of ounces can be traded in a single day with the click of a button. These are paper ounces, promises to deliver silver at a future date. The vast majority of these contracts are never intended to result in the delivery of metal. They are closed out before expiration, settled in cash, with the trader taking a profit or a loss. This paper market is a pricing mechanism, but it is also a leveraging mechanism. It allows participants to take a position on silver's price with only a small fraction of the total value as collateral, a margin payment. This leverage amplifies price movements and attracts speculative capital. It is a market of promises and bets. The physical market is a different universe. Here, silver is a physical commodity with specific dimensions, weight, and purity. It is mined, refined, cast into 1,000-ounce bars or smaller coins, and then shipped around the world. It is stored in vaults in London, New York, or Shanghai. It is sold to manufacturers who melt it down to make solar panels, electronics, jewelry, and silverware. In the physical market, you cannot create a bar of silver with a keyboard. You need a mine, a refinery, and time. The entire annual mine supply of silver is around 800 million ounces. The entire above-ground stock of investable silver bars, the kind held in vaults, is estimated to be only a few billion ounces. Compare that to the paper market. On the COMEX alone, the open interest, which represents the number of outstanding futures contracts, often represents a claim on hundreds of millions of ounces. On some days, the volume of paper ounces traded can exceed the entire world's annual mine production. This is the core of the imbalance. There is a mountain of paper claims sitting atop a much smaller hill of physical metal. For decades, this has not been a problem because the paper game was the only game in town. The system operated on the assumption that only a tiny fraction of paper contracts would ever demand physical delivery. It was a fractional reserve system for silver, much like the banking system is for dollars. As long as everyone believes the metal is there if needed, and as long as most players are happy to settle in cash, the system holds. The paper price becomes the accepted price for the physical metal because the arbitrage between the two is supposed to keep them aligned. If the physical price is higher, someone can buy a paper contract, take delivery of the cheap metal, and sell it in the physical market for a profit, thereby bringing the prices together. This mechanism is the link between the two worlds. But this link depends on one critical factor: the seamless availability of physical metal to satisfy those delivery requests. If that availability is questioned, the link breaks. The paper price and the physical price can diverge. The paper market can say silver is worth one price, but if you walk into a bullion dealer and try to buy a bar, you may pay a significantly different price. This is not theory. We have seen it in moments of stress. It is the crack in the foundation. The 3D111 figure is not a paper price target. It is what the mathematical model suggests the physical price must reach to rebalance the historic relationship with the paper stock market if and when the physical market asserts its ultimate authority. To gauge the pressure in the physical market, you must look at the vaults, the inventory data. This is the forensic evidence. The COMEX system classifies silver in its vaults into two categories: registered and eligible. Registered silver is the working inventory. These are bars that have been assayed, approved, and are sitting in the vault, ready to be delivered to fulfill a futures contract. They are the ammunition for the delivery process. Eligible silver is also in the vault, but it is held in a custodial account, often for an ETF like the iShares Silver Trust, SLV, or for a bank's own balance sheet. It is not immediately available for COMEX delivery unless the owner moves it into the registered category. The number that matters for the immediate supply pressure is the registered inventory. This is the buffer. Over the past several years, the trend in COMEX registered silver inventories has been one of decline. There have been periods of buildup, but the overall direction has been downward. From highs of over 120 million ounces several years ago, the registered category has at times fallen to below 30 million ounces. 30 million ounces. That is the readily deliverable silver to back a paper market that trades hundreds of millions of ounces in a single day. It is a buffer that represents just a few days of global mine production. This drawdown is a data point. It tells a story of metal leaving the exchange system. Where is it going? Some goes to industry, where it is consumed. Some goes into private vaults, held by investors who want it outside the banking system. Some is shipped east to financial centers in Shanghai, where demand has been insatiable. The steady decline in registered inventory is like watching the fuel gauge on a car during a long journey. The needle is moving toward empty. It does not mean the car stops the moment it hits zero. There is always the eligible stock that could be converted. But that conversion is not automatic. It requires the owner's permission. If the owners of that eligible metal, large ETFs or banks, see a frenzy for physical delivery, they may be reluctant to offer up their metal to bail out the paper market. They may choose to hold it, knowing its scarcity value is rising. This is how a supply crunch begins. Not with a sudden explosion, but with a slow, steady tightening. Each bar that leaves the registered category makes the remaining buffer thinner, more vulnerable to a delivery spike. The data is publicly available. It is reported weekly. It is not a secret. It is a slowly ticking counter. And when you combine the supply-side data with the inelastic industrial demand, the fact that solar panel makers and electronics companies must buy silver regardless of price, you have the ingredients for a dramatic event. The math of the 3011 target is not based on hope. It is based on the historical relationship between stocks and silver during a crisis of confidence. That historical relationship, the 2.24 ratio, occurred when the physical market briefly overpowered the paper narrative. The current inventory data suggests the physical market is getting tighter, setting the stage for a moment when that relationship could reassert itself with tremendous force. Why would the institutions that dominate the paper market allow such a situation to develop? What is their motive? It is essential to view this from a neutral, operational standpoint. Large banks and financial institutions are not villains in a story. They are participants following incentives within a system. Their primary motives are to generate revenue, manage risk, and provide liquidity for their clients. The derivatives markets, including silver futures, are a significant source of revenue. Revenue comes from trading profits, from facilitating client orders, from market-making activities where they profit from the bid-ask spread, and from lending and financing operations related to commodities. A deep, liquid, and somewhat volatile paper market is excellent for this business model. It attracts speculative capital, which generates commission and flow. The practice of selling futures contracts short, betting the price will fall, is a fundamental part of this ecosystem. Market makers often take short positions to hedge other exposures or to facilitate client buy orders. These short positions are often held with the expectation that they can be closed later by buying back a contract at a lower price, or that they can be rolled forward indefinitely. The system operates smoothly as long as the price discovery remains in the paper realm, and physical delivery is a rare event. The institution's motive is to keep this machine running. Acknowledging a severe physical shortage is counterproductive to this goal. It would immediately cause a violent spike in the paper price as shorts rush to cover, potentially causing massive losses for those with large short exposures. It would also destabilize the market, scare away liquidity, and attract regulatory scrutiny. Therefore, the operational incentive is to manage the day-to-day flows, use the paper market to absorb buying and selling pressure, and rely on the mechanisms of the market, like raising margin requirements or encouraging cash settlement, to prevent a physical delivery crisis. They are not trying to suppress the price for its own sake. They are trying to maintain the stability and profitability of the paper trading system. The short positions are a consequence of this system, not necessarily its master. However, this creates a profound conflict. The institution's motive to maintain a stable paper trading environment is at odds with the gathering storm in the physical market. They are essentially relying on the continued belief that the physical metal will always be available to backstop paper promises. The inventory data challenges that belief. The motive is one of short-term operational continuity, but it rests on a long-term physical reality that is changing. When a bank acts to provide liquidity by taking the other side of a trade, it is doing its job. But if that job requires it to sell paper promises for metal that is becoming increasingly scarce in the vaults, it is building up a contingent liability. This is the neutral, factual tension. It is not about good or evil. It is about a system that has functioned one way for 50 years, now facing a fundamental change in its underlying conditions. The motive to keep the game going is powerful, but it cannot repeal the laws of supply and demand forever. For the individual watching this unfold, the psychological toll is immense. Imagine seeing the math, understanding the imbalance, perhaps even owning some physical silver or a mining stock. Then you watch the price on the screen. It does not move in a straight line. It is a roller coaster. It surges on some news, then plunges the next day on a large sell order in the paper market. These swings can be violent. A 10% drop in a single session is not uncommon. This is where psychology breaks down. The logical part of your brain understands the long-term thesis, the deficit, the inventory drawdown, the inelastic demand. But the emotional reptilian part of your brain reacts to the color red on your screen. It sees loss, it feels fear, it screams at you to sell, to stop the pain, to escape the volatility. This emotional response is amplified by the environment around you. Mainstream financial commentary often dismisses silver as a speculative relic. Friends or family might question the logic of holding a metal that seems to go nowhere for years. The narrative of a bubble is constantly repeated whenever the price rallies. You are left feeling isolated, doubting your own research. This is the empathetic truth of the retail experience. You are up against not just market forces, but your own hardwired instincts. The paper market, with its algorithms and high-frequency traders, has no emotion. It has no fear. It can short millions of ounces into a declining market without a second thought, triggering stop-loss orders and creating cascading sell-offs. You, as a human, feel every drop. This volatility is not an accident. It is a feature of a leveraged paper market. It is a tool that washes out weak hands, those who understand the thesis intellectually but cannot stomach the psychological punishment. The path to a number like $3,111 is not a smooth upward slope. It is a chaotic, terrifying journey with steep cliffs and sudden valleys. Many who see the destination will not survive the trip. They will be shaken out during one of those violent corrections, selling in fear near a bottom, only to watch in agony as the price eventually recovers and moves higher. They will have been right about the story, but wrong about their own ability to endure the market's relentless psychological warfare. The key is not to outsmart the daily moves, but to outlast them. This requires a detachment from the screen price, a focus on the physical reality the math describes, and an acceptance that the paper market's gyrations are noise designed to provoke an emotional response. It is perhaps the hardest part of the entire equation. So, where does this leave us? Let us explore scenarios, not as advice, but as narrative possibilities based on the forces we have outlined. Scenario 1. The managed rebalance. In this path, the physical tightness continues to slowly intensify. Industrial demand remains robust, and investment demand grows gradually. The paper market continues to dominate daily pricing, but the physical premium, the extra cost to get actual metal, steadily climbs. Central banks or other large entities avoid a sudden catastrophic demand for delivery. The price moves higher in a volatile stair-step fashion over many years. The ratio between the S&P 500 and silver begins to compress slowly. The 3,111 figure remains a mathematical guidepost, but it is approached gradually, perhaps a decade from now, through a combination of a higher silver price and a lower stock market valuation in real terms. This is the slow burn resolution. Scenario 2, the catalytic event. Here, a specific trigger breaks the link between paper and physical. It could be a major industrial user failing to secure metal and declaring a force majeure. It could be a sovereign nation making a very large public demand for physical delivery on the exchange. It could be the registered inventory of a key exchange like the COMEX falling to a critically low level, prompting legitimate fears of a delivery failure. In this scenario, the paper market experiences a short squeeze of historic proportions. Entities with large short paper positions are forced to buy back contracts at any price, but find that buying paper only pushes the price higher as the physical shortage becomes the dominant narrative. The price gaps up violently. The path to a number like $3,111 could be measured in weeks or months, not years. The stock market, facing a crisis of confidence in the monetary system, sells off sharply, accelerating the ratio compression from both sides. This is the chaotic, disruptive resolution. Scenario 3, the policy response. Faced with the prospect of a runaway commodity price disrupting the green energy transition and fueling inflation, governments and central banks intervene directly. They could release strategic metal stockpiles, if they exist. They could impose trading restrictions, capital controls, or even nationalize certain silver supplies. They could engineer a severe economic downturn through aggressive interest rate hikes to destroy industrial demand. In this scenario, the physical shortage is overridden by political force. The price is suppressed, but at the cost of economic recession and the stalling of strategic industries. The mathematical ratio remains distorted, but the market is no longer free to find its equilibrium. This is the controlled but economically painful resolution. These are stories the data allows us to tell. They are not predictions. They are frameworks for understanding the potential endgames of a profound market imbalance. The number 3,111 is not a promise. It is a lighthouse, visible through the mathematical fog. It shows where the rocks are and where the deep water lies. Whether the ship of the market sails toward it slowly, crashes into it suddenly, or is steered violently away from it by an outside hand is the story that is still being written. The only constant is the imbalance itself. The $6.3 trillion is not gone in a literal sense. It is the measure of the gap, the distance between a paper valuation built on confidence and a physical valuation built on scarcity. That gap is now the most important number in the room.